Numbers don't panic. People do. Let's look at the psychology driving the market. When markets experience significant stress, the conversation quickly turns to the possibility of official policy intervention or financial rescue. This expectation of a safety net acts as a quiet assurance, modifying how investors view risk. The belief that authorities will step in to prevent deep losses spreads through the market. As this expectation becomes a shared narrative, it changes the crowd's behavior. Investors begin to ignore downside warnings, assuming that their worst-case scenarios are effectively backstopped by public policy support. Notice the distinction. The safety net is not just a regulatory mechanism. It is a psychological coordinate that alters how the crowd values risk, compressing volatility long before any policy is executed. This compressed risk perception encourages participants to increase their exposure, believing that they can capture upside returns without facing the full cost of failure under normal market volatility conditions. Why does the belief in a safety net make markets more fragile? The answer lies in how the expectation of rescue shifts collective risk-taking norms, encouraging crowded herding into vulnerable assets. The core problem is that safety expectations generate a moral hazard-driven environment. When investors believe that losses are capped by policy, they adjust their models to accept higher leverage. This leverage buildup is a direct response to the perceived backstop. The crowd coordinate their actions around the belief that they will be rescued, pushing asset valuations beyond sustainable fundamental levels. Under these market conditions, the crowd ignores the structural weaknesses of the assets they own. They focus entirely on the safety story, assuming that official support makes analysis of underlying risk unnecessary. This narrative focus leads to narrative contagion. As the expectation of rescue spreads, the crowd begins to herd into similar exposures, assuming that size provides protection since a bailout is more likely. The observable consequence is a market that appears robust but is structurally brittle. The collective expectation of intervention becomes the very force that prevents normal price discovery and market clearing. Look at this feedback loop. Intervention expectations encourage risk-taking. Risk-taking increases systemic fragility. Rising fragility pressures authorities to intervene, and actual interventions reinforce the crowd's belief in the safety net. To understand this, we must define collective risk perception. It is the shared process by which market participants evaluate, coordinate, and price potential downsides under the influence of narrative stories. Now, this perception is heavily shaped by past interventions. When investors observe that previous downturns were resolved by policy rescue, they build those outcomes into their present investment frameworks. This historical feedback is consistent with moral hazard. The memory of official support acts as a psychological buffer, reducing the fear of loss and coordinating the crowd into highly correlated exposures. This coordination is not driven by fundamentals, but by policy expectations. The crowd herded into these assets is united by a single story: that the authorities cannot afford to let them fail. We must distinguish hopes from formal commitments. The crowd often mistakes policy whispers and past actions for guaranteed future rescues, ignoring the political and economic limits that constrain official intervention. These limits can create sudden narrative disruptions. If authorities hesitate or refuse to intervene during a crisis, the crowd's expectations are violated, triggering a rapid and unhedged decompression of positions. This decompression is particularly violent because the crowd did not buy protection. They relied on the implicit policy guarantee, leaving them exposed when the safety net is not immediately deployed. This reveals the fragility of safety expectations. The belief in a backstop encourages the very behavior that makes a backstop necessary, creating a system that is structurally dependent on policy support. The core mechanism begins when policy statements or historical precedents establish the belief in an official safety net. This belief acts as a silent coordinator across the financial markets. As participants incorporate this backstop into their models, they reduce their demand for downside hedges. The price of risk protection falls, compressing volatility and encouraging further allocation into risky assets. This volatility compression is interpreted by the crowd as a signal of fundamental stability. They herded into crowded exposures, assuming that the market has become structurally safer and more predictable. When a sudden disruption threatens these positions, cognitive dissonance rises. Investors who expected safety must reconcile their losses with the absence of immediate official intervention or policy rescue statements. To resolve this conflict, the crowd looks for signs of policy support. They analyze every official statement and media report, searching for validation that the safety net remains active. This narrative search coordinates the crowd's behavior during the early phase of a decline. If the backstop is delayed, the initial complacency is replaced by a coordinated demand for exit. This sudden demand for exit exposes the liquidity bottleneck. Because everyone assumed they were protected, they held similar crowded positions and now attempt to liquidate them at the same time. Follow the liquidation cascade. As prices fall, the leveraged positions built on the safety story are forced to close. Margin calls trigger automated sales, accelerating the decline across unrelated assets. This cascade is consistent with reflexivity, where falling prices feed the panic narrative. The crowd's belief in the safety net is replaced by fear of a policy failure, driving herding behavior. During this phase, correlations spike as participants sell what they can. The diversification they relied on disappears as the entire market coordinates around the immediate need for cash and preservation. This mechanism shows that safety expectations shape market structure. The belief in a rescue does not eliminate risk, it simply shifts it into a hidden, crowded concentration that decompresses violently. At the same time, the illusion is maintained by successful past interventions. When a bailout succeeds, it validates the safety narrative, encouraging larger leverage and herding in the next cycle. This cyclical behavior makes each subsequent crisis potentially larger. The crowd expects a larger safety net, taking greater risks and forcing the authorities to coordinate larger rescues to maintain stability. This feedback loop between policy and crowd psychology is the true driver of fragility. It shows that expectations of safety are not passive calculations but active forces that alter market mechanics. By failing to recognize this endogenous dynamic, herded investors remain vulnerable. They continue to treat policy backstops as risk reduction tools, ignoring how those backstops coordinate the crowd into danger. To evaluate this model, we must establish its boundaries. Not all policy expectations generate moral hazard. Sometimes, clear and transparent regulations can reduce uncertainty without encouraging excessive risk-taking behavior. Under these conditions, a well-defined framework helps participants manage risk independently, representing a stabilizing structure rather than a psychological backstop that coordinates their crowded positioning and excessive leverage. Additionally, this behavioral analysis has limitations. It does not allow us to predict when political constraints will prevent a bailout, as regulatory decisions are shaped by external factors. One key distinction is between systemic interventions and individual firm rescues. While systemic backstops alter broad market sentiment, rescuing a single firm does not always coordinate market-wide risk-taking norms. We must also note that safety nets can prevent destructive cascades. In periods of extreme panic, the expectation of intervention can stabilize sentiment, showing that backstops are not always harmful. However, historical episodes like the expansion of implicit guarantees before the 2008 crisis provide a validating case. The belief in policy support encouraged systemic herding and excessive leverage. By defining these boundaries, we clarify our focus. We are analyzing a specific mechanism where expected rescues alter collective risk perception, rather than making a general claim about all regulation. This brings us back to our opening question of why safety net beliefs make markets fragile. The answer lies in the psychological normalization of risk under policy expectations. The bailout whisper leads participants to treat implicit guarantees as assets. This belief alters their behavior, driving herding, compressing risk premia, and encouraging the accumulation of systemic leverage. By recognizing this mechanism, we can see that expected interventions are double-edged. The calm they provide during quiet times is purchased at the cost of coordinated fragility during stress. This insight allows us to analyze market safety narratives more critically. We look past the policy promises and ask whether the stability is supported by fundamentals or by shared complacency. Rather than assuming that official support guarantees safety, we study the crowd's positioning around that support. We check if the safety narrative has coordinated the herd into crowded exposures. Notice the distinction. We are not criticizing regulatory policy, but pointing out that the crowd's interpretation of policy acts as an independent force that shapes market structures and dynamics. When a market is herded, it requires smaller shocks to trigger large movements. The system becomes sensitive to minor changes because there are no diverse views to absorb the selling pressure. By studying this narrative psychology, we learn to evaluate policy expectations with caution. We observe the safety cycle without relying on it, maintaining our analytical focus on herded positioning. Target the mechanism, not the promise. The goal is to understand how the crowd's search for safety can create the very conditions that make the market structurally fragile. In practice, we can monitor the bailout narrative by tracking policy-sensitive asset spreads. When spreads compress during political debates, it suggests that the crowd is pricing in a rescue. We can also analyze the growth of leveraged products that rely on stable policy environments. Rising issuance of these products indicates that participants are expanding their risk limits. Another practical step is to evaluate the political viability of future interventions. Check if public sentiment or legislative rules are changing in ways that would prevent a timely rescue. These observation steps do not replace traditional credit analysis. They represent a behavioral tool designed to help us recognize when safety expectations are coordinating the crowd into vulnerable positions. We must also check if diverse views are present in the policy debate. In herded markets, warnings about moral hazard are often ignored, indicating that the safety narrative is dominant. Avoid using policy expectations as trading signals. Knowing that the crowd is herded around a bailout story does not tell us when a policy shift will occur. Keep our focus educational. By studying these narrative feedback loops, we aim to understand the structural properties of markets rather than attempting to predict short-term price adjustments. Consult professional financial advisors for portfolio planning. Our goal is to analyze the psychological mechanisms of collective risk, rather than offering specific trading setups or investment recommendations. We must look past the implicit guarantees and analyze the herded behavior that coordinates around them. Don't follow the herd. Study it. See you next time.